Nice to have you back at Happy Investors, where we talk about investing and stocks in ETFs. This time, an edition viewed from the perspective of starting to invest. Now that I am 10 years further along, there are a number of important tips that I would give to you, including those I give to my sisters, my friends, and my father. I would wish the same for everyone. And that is returns from investing. But for that, you need to be very realistic. What works and what doesn't. That's what we are going to talk about. First, we will discuss a number of crucial tips for starting to invest. Secondly, we are going to talk about my own stock portfolio in this video. How can you invest in stocks? And also the status of my stock portfolio at this moment. And the third is about investing in ETFs. Also again, seen from my own portfolio, where I have a number of special positions. You can certainly make a clear move on a certain transition, and that can turn out well or poorly. I also do not recommend anyone to copy my portfolio. That is also very important. Let's talk about that. About some basic tips, about starting to invest. Alright, starting to invest. How do you do that? We're not going to talk about selecting brokers or setting up an account. That's all super basic and simple, and anyone can tell you that. Actually, what I would like to give myself as advice, now that I am 10 years further along, is to take a look at what exactly your goal is, and what risk and return would you like to achieve. Because actually, the most important lesson is about the compounding effect, also known as compound interest or interest on interest, dividend on dividend, return on return, however you want to call it. The point is that the longer you are in the market, the more you do not want to disrupt the process of compounding. This means that you actually shouldn't take any risk, or should take a lower risk in order to achieve a positive return every year. Of course, stocks come with their ups and downs. The most important thing is simply not to disrupt the process and to achieve a higher return on average, because it doesn't have to be an extremely high return. As long as it yields a high return, for example, higher than saving or at least higher than inflation. This is also the reason why people in real estate seem to perform better than in stocks. It is demonstrably true that stocks achieve a higher average return. However, stocks come with ups and downs. In real estate, it's often a yes, even if you buy a bad property. With a lot of patience, you can recover from that bad purchase, simply because the value of the capital grows along with inflation, and if you're lucky, it grows even faster during certain periods. And all that time, you still receive rental income. So even if you make a bad purchase with real estate, you can still get away with it. However, if you buy bad stocks, you cannot get away with it. Then you simply have mistakes, and you need to avoid that. So basically, the fundamental tip, and this is the most important one, is to always start with long-term investing and never disrupt the compounding effect, never. That is the basic rule. And if you do that, then the most important thing is that if you start investing now, you only need to invest 300 euros per month. This is possible because, for example, you are older. That is possible, but you can still do it for example, those children, those. Imagine even investing for a baby. Start now, invest 300 euros monthly. Invest 300, and in a month, it's retired. Money lost. With a return of about 7 to 8%, your child will likely be financially free by the age of 40. He won't have to work anymore. It's that simple. That is the power of returns. However, the only thing is, you can never look 40 years ahead. But the compounding effect and starting as early as possible are truly crucial. The second step is actually about putting together the realization that I need returns and I want to hold on to them for as long as possible. So, it starts with mindset and long-term investing. Actually, what you want to do next is determine for yourself, okay, what exactly is my financial goal? Actually, the most beautiful thing is being able to achieve a certain financial goal in, for example, 30 or 40 years with a relatively lower return. Then you shouldn't be talking about a 3% return, because you might as well invest in bonds or other savings products, but 6% or 7% is achievable for an average investor. It all starts with the goal, and that is simply, okay, I start now. With a certain amount of money, I will add a little bit every month, and at some point, I will end up somewhere. And if you don't know how to calculate that, you can download a calculator on our website, Happy Investors. It's completely free, 100% free. And that calculation tool is super handy. I have always used it myself to calculate my wealth in the future. And the most important thing is, we never disturb the returns or the process of compounding returns. You can do it yourself, but you have to do it yourself. What you want to do is determine your investment strategy. However, you don't do this based solely on your own knowledge or skills. Instead, you actually start by thinking about risk and return, particularly the aspect of risk. If you don't need a High return because you can achieve a certain goal with, for example, a 6 or 7% return. Let's assume for convenience a 7% return. Then you are a happy person because you can simply invest in exchange traded funds or ETFs, which is actually another term for Ash mutual funds. A stock fund contains many different stocks, and you simply follow a group of stocks. You can do this worldwide. That has the least risk in principle, and what it offers in return is also a relatively lower yield. But still, an average of 7% over a very long time period of 20 or 30 years is simply achievable. So everyone who wants to start investing and doesn't really have much knowledge about it, which most people also have, including myself when I just started, just stick with ETFs. Keep it simple. You basically only need 2 or 3 for a lot of diversification around the world. Then you have invested in the global economy. It's really that simple. And make sure those ETFs are low cost. Well, you can find more information about that on our channel, Happy Investors, or on our website. We also have a little course, very free or very accessible for ETFs. It's all not that exciting. Do you want high returns, for example, minus? That's what I do myself. But when I was young, I made relatively many mistakes. So I doubt, now that I look back after 10 years, I have never really kept track, but I can roughly estimate that I certainly haven't achieved above average returns, and to be completely honest, I may have even achieved lower returns. Now for the past 3 years, that's a different story. I have been achieving consistently higher returns, but it's only for the next 3 years. So the question is, am I lucky here? Or will I now demonstrably achieve a better return? I expect the latter, but that is of course more a matter of hoping and investing all the time. That is also an advantage of investing in stocks. If you are really interested in business, in entrepreneurship, but also in other areas such as psychology and mindset, and a bit of macroeconomic economics, although that is not the most important for stocks, then it is simply very educational to invest in stocks, as you will delve into those companies. Stocks are shares of companies, so you need to learn to understand companies. You must understand how they can grow, then you will look at management, quality, and you will examine quantitative data. So, a lot of interesting resources, and that's just really good for your own learning process. Hey there, real quick, my name is Joris van Molen. I have over a decade of experience in investments and also in entrepreneurship. I have an old company called Happy Investors in the Netherlands, and we share information about stock investing where we provide the S&P 500 and also various other index funds. Through this channel, Business Investor, I share a lot of knowledge for free, not to ask for anything, but I would love to hear your thoughts. So, I would really appreciate it if you subscribe, follow, and share the videos with your friends. The essence of this channel, Business Investors, is to help you achieve financial freedom. Stocks may potentially have lower returns in the short term compared to, for example, ETFs, simply because you make more mistakes and therefore achieve a lower return. But it is also a way of investing in yourself. Well, you can make it even worse, for example, by investing all your money entirely in a single business. I happen to do both entrepreneurship and investing in stocks. I also have ETFs, by the way. But then you actually have a kind of focus strategy. A focus strategy is seen by governments as the best way to invest in stocks to achieve even higher returns. So potentially 15%, maybe even 20% per year if you are very good over long periods of time, but very few people actually achieve that. In principle, a focus strategy is correct. It is the best way to invest. However, this means you need to know all those companies very well, and it results in having a smaller selection of stocks in your portfolio, which is why it is called a focus. For example, 10 stocks or maybe 15 with the 5 largest stocks receiving the largest percentage of your assets. However, if you do that, you must come from very good stock, and that is simply still a step too far for beginner investors. Additionally, a bit about risk diversification. If you are going to invest in stocks, and you are doing it for your own learning process, plus you want to potentially achieve higher returns, that is possible, but do not start on your own. That is not wise. I have done it, but even then, you will naturally learn from many other investors. There are also super investors. On dataroaming.com, you can see what they have in their portfolio. And there are other people you can follow who are many years ahead of you. Mistakes can happen in any case. Additionally, there is something very interesting that I did here with Jim. This book is not new, by the way, but it is called The Black Swan, and that is by Nassim Taleb. This book is written in English and is a bit difficult and complex. There might also be a Dutch version, but I have no idea. You also need some basic knowledge of statistics. But basically, it comes down to the black swan. These are certain events that people cannot foresee because you simply do not think about them. However, those events do determine both history and the future. And with investing, a very important part of it is simply luck. You can analyze companies to the point of exhaustion, but you never know 100% for sure if that company will really be the biggest player in that industry in 20 or 30 years. That is why I have a different strategy compared to most people. I really enjoy investing in relatively small companies. The uncertainty is very high, the chance of failure is even higher, and therefore I consciously invest smaller amounts in multiple companies to spread my risk, but also to increase my luck factor a bit. Because I only need a few, let's say 3 or 4, that will really become the biggest in the world in the future. There are many characteristics to consider in such a company, but it really comes down to what your investment strategy is. Your investment strategy should be based on risk, and the risk profile should be based on the goal you want to achieve. So once again, if you are a happy person, you do not need much return to achieve your financial goal. There are a number of ways to do this, either by putting your money in the market for a longer period of time, or simply by increasing the monthly amount while you are investing. If you do those two things, and you have a return of let's say 7%, then you can simply invest in ETFs. It's simple and passive, with relatively low costs as well. You don't have to worry about it, and your risk is very well diversified. The only thing you need to have is a lot of patience, which is already difficult for most people. If you want to achieve higher returns, as I mentioned earlier, then we will invest in assets. Well, let's take a look at my portfolio. To the second part, which is investing in stocks, and the third part is investing in ETFs. Both can be found in my own portfolio. I often provide an update of my portfolio. I try to do it every month. Do not see this as tips or buying advice. Always invest your own time and research in companies, and only invest in companies that you understand 100%. But I will give you some tips here and there about how I see things to at least avoid risks and prevent my past mistakes. In the second part, we will look at my stock portfolio. This also serves as an update for frequent followers of happy investors regarding the stock positions. And again, this is not investment advice. Now you are a beginner investor and really don't know how to start, starting with DEGIRO. I invest myself through DEGIRO, but also with interactive brokers. I suggest our DEGIRO explanation. It's an intro review video on DEGIRO basics and how you can buy and sell stocks. Here, we go further. We've set up and monitor a stock portfolio. But before we start with that, I want to emphasize a few things. You see, I have relatively many stocks, but you see they are relatively smaller amounts in all those stocks. And some stocks are actually a kind of mini ETF. So this is a bundle of different stocks. And then you might ask yourself, how can you keep track of all those stocks? Well, I have a lot of different tools and data for that, because there are actually two crucial differences. The very first is, and I think this is really the best strategy, is to invest in actually the very best companies in the world. I try to do that, but the challenge with investing in the very best companies in the world is that they are often highly valued. And even now, they are again highly valued. I'll show you an example. I've actually had ASML in my portfolio for quite a while. By the way, I also had Nvidia, but as I mentioned, I've made mistakes. Mistakes do not always mean that you are taking too much risk, but mistakes also mean that you sell too early. I sold Nvidia much too early. Too bad. If I had just held onto it, just like with ASML, I would have had much higher profits. So you can also see my total profit and earnings stand at 6,000 rounded off, but I now only have a very small position of 800. I actually only have one focus, and that is the only reason I am still doing this. I think ASML is a great company, just like many Dutch people do, and I just want to keep following it in my portfolio, but I don't think this is the right time to invest in ASML. Another example is Booking Holdings. I have a position in it and it has a 20% return, that's fine, but I wouldn't buy more shares of Booking at this moment. Actually, I am just waiting for a significant correction to occur. And as long as that doesn't happen, I can invest in the second option, namely relatively good companies, at a very good price. So in summary, the Warren Buffett strategy is to buy great companies at a fair price. The strategy is to buy great companies at a fair price. And a less favorable alternative is to buy good companies at a very good price. And I also make use of various tools and data, particularly for a bit of momentum. When looking over a period of 20 years, it is very difficult to estimate which companies are the strongest. If you look at a time frame of 12 to 24 months, it becomes easier to predict which stocks are in very strong momentum. So simply put, you want to buy companies at a lower price. That beautiful short-term profit growth will be realized, led by excellent management and also having strong momentum. Actually, there are a few different factors, and as a result, you can achieve relatively high returns without really knowing those companies inside and out. Another example, Celestica. Celestica is simply an example of a great company. At this moment, I would not buy. In fact, I am selling. But when I bought Celestica, the valuation was very good and the prospects were very favorable. Well, that has proven to be the case. There is also one that I underestimated, such as ACM Research, and it is currently down 23%. So it doesn't only have advantages, it can also turn out badly. I try to present it as objectively as possible, but on average, I am now achieving significantly higher returns than the average, and this is also stated on our website, Happy Investors, where we have been applying my strategy that allows for risk. Go to our website, businessinvestors.info, where you can find our own track record of money invested and our performance. Then, go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, also free investing ebooks, ETFs investing guide, stock investing guide, and more coming soon. Avoid. Relatively buy more stocks but with favorable prospects. We simply achieve demonstrably high returns. Celestica is an example of this. You see a value of 2,500 here, but this is actually incorrect. I will show you why, because it has been converted. It was a kind of administrative selection, which is why it now appears to show a 20% return, but the actual return is much higher. And I can show you, I'm going to transactions now, and we are going to look up Celestica. And we see here that the first time I bought Celestica was at 25.08, and I bought it again at 31.10. And the total value of that, when added together, is $2,000. You see 25, let me look it up, 25 25. August and October 30 was. So the first time I bought a Celestica, and you can see the power of the strategy I apply, by the way, but the first time I bought it was August 25th, so that was actually here, and the return was at 156%. The second time was on October 31st, which is here, and that return was at 140%. Then I sold half in March 2024. Why? Because Celestica is not a mega great company that I think will really be the winner in 10 years. So at this moment, I think Celestica is either partially or fully valued or slightly overvalued. I just said I am selling 2,000 euros and I am simply taking out my initial investment. So I have taken out my initial investment, and you see I still have 50 shares in Celestica. Only this here has been converted. It was some sort of administrative action. No idea exactly why, but he was converted from Celestica Inc. to Celestica Common Stock. And you can see that reflected in my portfolio now. So basically I have had nice returns on a number of stocks like Celestica, but I just take half out because I don't want to take risks, or at least want to take less risk. That is not always the best strategy. You also want to let your winners run, but that's why I don't take everything out. Another example is doing well, but it is a bit riskier. This is actually a summary of why I have multiple stocks in my portfolio and also a completely different strategy. So in the long term, I want to invest in the potentially best companies at a good price. The challenge is that this is also one of the reasons why I filled such a company. Is it now that a too high price is being asked for most companies, not for all, but for most? Until that time, I want to fill my assets with companies like Apple, and to Dylan Mike Dewis, I say audio traps. And until that time, I actually want to fill my assets with companies like Apple or an app-loving company. What is it? A Despegar, quite risky. And hims and hers, they are also doing very well. So relatively good companies with interesting growth potential to achieve returns and thereby beat the market. Even if they are not great companies, they are just decent companies that are bought at a good valuation. Another aspect of this story is that it seems I am fully or almost fully invested with my assets. However, I also have an indirect brokerage account, which I have shown you in other videos. There is also a serious amount on it, and ultimately it comes down to the fact that I have about 40% in cash. So this is not my total wealth, but of that 180, 170 is invested. So the portfolio is 170,000 invested, and I have 40% in 1,000 or 40% in cash. That's actually quite a lot. Actually, you want to be 100% invested to create returns. Am I timing the market here? Yes and no, but actually mostly no. Here, a piece of mindset comes into play again. Earlier in the video, We started with the idea that when you begin investing, you need to determine what your financial goal is and what kind of risks or return profile you are willing to take. Well, with this amount of money I have here, the 170 or 180K. At my age of 32, I don't need to achieve such a high return by the time I'm 40, but especially by the time I'm 50 or 60. Then I will have way too much money. I actually don't need that money anymore anyway, but then I have even more money. And of course, I enjoy making returns, and then I can invest that money. Or I should say, the returns on my assets, into my family or into things that I believe are important, which improve the world according to my way of life. And so I can use the money in a certain way because it's just money. It doesn't make sense, but that's mindset. So for me, with that 170,000, if I can just achieve a positive return on it, and my goal is of course a higher return, but I'm not going to aim for 15% per year because that's not going to happen. But if I can achieve 15% per year, that would be great. In my own calculations, I take into account a return of 10 to 12%. If I achieve 12%, then I will indeed be a very happy man financially. And that is very important. So the 40% cash position that I currently have, I do not need to achieve my financial goal. So I am not really timing the market. I am playing a game. And I can achieve my goals with this position. If the market were to crash in any way, stocks are relatively high, but you can never be sure if they will continue. However, if something happens, I will achieve my goal much sooner, because I will suddenly have 40% cash that I can then invest. So starting with a specific financial goal, and always keeping that in mind, not letting yourself be swayed. Because it's just money, but having a certain direction is very important in guiding your strategy in later years. And because of that, you can start making different choices. Choices that help you in life. In this case, it will also help me with that 170K, so I can achieve my goal. While I am achieving returns, in the worst case scenario, I would need to deploy that 40% cash, and in the best case scenario, I can use that 40% cash when a serious market correction occurs. And there I will achieve my goal even earlier. Well, now in the third part, I will provide some updates on the stock portfolio for those who follow us more frequently. Let's first start with the transactions. In the last month, the following transactions took place. Let's ignore Badaware in this context. I fell into the traps again by hastily buying a stock, but Badaware in Mexico is not a unique company, yet it is an interesting company and actually has a very good valuation. But still, I had bought and a week later I sold and I thought, no, I shouldn't buy too quickly. Jorik, watch out for your pitfalls. So I just show everything very honestly because nobody is perfect. And when you start investing, you are definitely going to make a lot of mistakes. You need to know yourself well and try to avoid those pitfalls. And you can always correct those mistakes, as I have done in this case with Better Weather Mexico. But I still find it an interesting company, so I will continue to follow it. And if it drops significantly one time, but the fundamentals remain strong, then I might consider buying these stocks again. So aside from that, I bought more of StoneCo this month. Actually, this is the stock that I secretly have a lot of confidence in. But you can see that when you have a lot of trust in certain companies, and with some, you have a bit less trust. That is a very important point, often significantly better. And those you have a lot of confidence in are disappointing. StoneCo is not doing so well. I will see last, it is still in the negative. But StoneCo remains very interesting, and maybe I will even consider buying more, because there is a difference between highs and lows, but StoneCo remains very interesting. The price, so the price tag, and you have the difference between value, the intrinsic value. There is a quote that says, price is what you pay, and value is what you get. And then it concerns StoneCo, the intrinsic value. I believe that StoneCo is worth more than what you can currently buy it for. So I think that the stock prices are currently below the intrinsic value of the company. Therefore, I believe that StoneCo is a good investment, but I could also be wrong. I have bought more shares of Saco's energy shipping stock, which is performing very well. I will show you in a moment. I have also bought more of Despegar, which is doing very well too. I sold Loma Negra Campania from my mini ETF of Argentine stocks, which makes cement and bricks. I bought a little more of Salesforce. I had purchased it at a good valuation. Then I bought a second portion of Salesforce, actually just before the earnings, and that turned out to be particularly bad, as it then dropped by about 20%. Now it is starting to rise again. But that is typically short in my view of the market from which you can profit. So if the negative trend continues, I will buy more Salesforce shares at a lower price. And this is what I mean by examples of strong companies that from time to time do receive a more attractive valuation, or at least a fair price. And I think that Salesforce is one of the best companies in the world at this moment. Not the very best, but definitely one of the best. I bought more of an ETF, but that refers to the third part. And we see sold Dr. Horton, again achieving a very high return, more than 100%, and sold Intesa Sanpaolo. Intesa Sanpaolo has achieved about a 30% return. It's an Italian bank that I bought just before all those interest rate changes started. It looked good at that time. Well, it has increased by about 30%, percentage increase. I even bought more later, also realizing some returns. The stock is no longer undervalued according to the statistics and sources I use, so it's time to say goodbye to it. Not a great company, it's a bank, and I'm not a banker. I sold smaller positions. I still achieved high returns. Don't forget, there's also a dividend of 10%. Actually, my annual return is around 40%. So even with not very special companies, you could still achieve a high return. Don't forget, a 40% return was significantly higher than the S&P 500 during the same period, which only achieved about 15 to 20%. So just double. A number of stocks are doing particularly well. I have made separate videos on this, so I will refer to those as they are still relevant. First of all, the mini ETF for Argentine stocks. Banco Macro, Centro Puerto, Cresud, Pampa Energia, and IPF. I recently bought more IPF. Not this month, but some time ago. You see, they are actually doing quite well. It's risky, with smaller amounts invested, and I think Argentine stocks are still interesting at the moment. For that, check out the video about Argentine stocks. Then we have shipping stocks. I have quite a few of those, and I've been mentioning this for at least a year and a half. Boring shipping stocks. The outlook is just very good, especially because not many ships are being built, and demand is still going to rise no matter how you look at it. Risky assets, commodities, cycles, so there are many ways or reasons not to invest in them. I wouldn't recommend this to anyone, but I invest in it and it works out well for me. If you are a beginner investor, I would avoid this type of stock as it is a certain way of investing based on cycles. That is one of the better stocks at the moment in terms of fundamentals. Ardmore Shipping and Miko International Shipping are examples, with Miko still at 80%. We have DHT Holdings. It's not doing super well, but I also didn't buy it very long ago. Frontline is one of the better stocks at the moment in terms of fundamentals. And then you also have a few things you can use to help yourself. Dividends, I say, are risky, but the balances are improving. And the return is just very good at the moment. The last stock I bought is Golden Ocean Group. That is just a kind of different career than, for example, those that are in Frontline. As for the round of investments, who goes through Lakes or Frontline? For example, Scorpio tankers are still in the portfolio, up 100% and performing well. And I had indicated that I bought a little more of Saco's Energy Navigations, which has caused my return to be slightly lower due to the increased average purchase price. And also, TK Tankers, up 50%. So these Argentine stocks and shipping stocks are actually concentrated stocks for an energy theme. And that theme of energy will also be reflected in my ETF portfolio. But before we get there, energy, I have never had so many positions in energy stocks. That is also risky. I already mentioned it. They are cyclical stocks. If you don't know what a cyclical stock is, look it up on the internet. Learn about it, understand it. It can also turn out very wrong. I think, based on this, that it is actually a form of value investing, that this is currently the better opportunity for me, given the specific circumstances in the market. Then there is actually just another group, and those are just the normal companies, you could say. Some do well, but some do poorly. One that turns out poorly is ACM Research. I will explain why I am not worried about ACM Research. I selected this stock and I was very aware of the negative aspects of this story, but the stock is in the semiconductor sector, which is relatively a useful sector for the future, so it is future oriented. It is led by a Chinese management team, which is not great, so I knew that. That's why I invested a relatively smaller amount. However, ACM Research had a good outlook at the time I bought it. And the valuation was relatively okay, with a PI ratio of around 25 and a cash flow of around 20. So what do we see now? That ACM Research has dropped quite a bit in a short time. So let me show you why I'm not worried about that. First of all, it's not a great stock, and I bought it somewhere around here. Yes, about something like here, and it's currently down, what is it, minus 25% for convenience. The valuation was already okay here, and the outlook was good. Well, you see, and sometimes this happens, a negative trend arises, and it is now down 25%. However, we see that the price to earnings ratio has dropped to 16, and the profit outlook for this company has really not changed in 2 months. A company does not change so quickly in such a short time. Here you have the story of Mr. Market who wants to pay a certain price, sometimes a lot, sometimes very little. And you have the reality of companies that have a chance to do well, because ACM Resource has a very good balance sheet, has almost no debt, a strong cash position, a very steady history of revenue growth and profit growth, which is very important, and the valuation has become relatively attractive. So actually, instead of making myself anxious about selling now, I should be buying more. But here I feel that, well, it's not a great company. It is also not a good company. It is actually an average company. So you need to be very honest and realistic. So, are you going to invest more in a mediocre company? No, because for me, this was more of a speculative push based on all the data and sources I use, and sometimes it works out well, as I have already shown with Celeste Decal. And yes, sometimes there is a loser. The point is that if you have a bundle of 10 and on average you have a high return, you are still doing well in the end, even if there is a loser among them. I will not buy more of a loser. I prefer to add to my winners. So, that's actually reasoning in the opposite way. Speaking of that, I already mentioned it. I thought StoneCo would be one of my better winners, both in the short term and the long term. But it seems that it could only be on the long term, as in the short term, it is also down 18%. However, I recently also bought a little more of StoneCo at a lower valuation. So actually, in my opinion, the initial amount is also at something like, yes, minus 25%. And here too, the recent quarterly figures were just excellent. The valuation has actually improved slightly in the short term. I think that StoneCo is worth much more than what the market is currently willing to pay for it. You can also see that the ETF for Brazil is starting to decline, so that may also impact StoneCo and its competitor, ParSeguro. For more information about these stocks, check out the video on stocks in Brazil. Lastly, I want to emphasize HIMS and HERS. HIMS and HERS was actually also before my period of taking too much risk. And I am still struggling with that, for example, with PayPal and Upstart Holdings. Here I look, at least 70%, way too risky. And the irony was that I had also picked up some currency exchange at first. And then I let my emotions be guided by emotions. And the HIMS and HERS was actually also before that period. Now I try to maintain much more diversification and to be much stricter on selection criteria. For example, a company must be profitable, even if it is small, it must be profitable. And HIMS and HERS has not been profitable for a long time, but is now starting to become profitable. And then you also see Mr. Market in action again. A company like HIMS and HERS is very difficult to value in the short term. And what happens then? News has a strong impact on such stock prices. HIMS and HERS, I started taking my position somewhere around here in 2021 in Dendan, the trend. 20. In the declining trend. I have also indicated several times in other videos that I won't do that anymore. So I am now also using technical analysis to determine my entry point. And actually, I have determined my entry point again for HIMS and HERS, as I haven't bought more for a long time. Actually, I waited for a while. And somewhere here, I bought more shares of HIMS and HERS, just a little bit, but it has improved my average purchase price. But you see an enormous increase, really not normal, a huge spike in the short term of 35%, and what is it for the year? Up 100%. Mine is also at 100%. HIMS, yes, 100% coincidentally. And what is happening here? There was some news about HIMS. Adding new drugs. I shouldn't say drugs, but a kind of weight loss product to its assortment. And as a result, the market is suddenly going to rise a lot. That is typically a short-term market reaction. It could very well continue to rise, and if that goes on for a while, I will sell part of it again, because the valuation is starting to get quite high. But HIMS and HERS has very interesting characteristics. At the beginning of the video, I talked about my investment strategy. Small companies that have the potential to succeed based on a scalable business model and good management, often with the CEO still as the founder, in a relevant market where they operate, a good market where there is still profit to be made. Stocks of this kind, with a good balance,
can become a 10 bagger or even a 100 bagger over time. A condition for this is that you buy them early when they are still small. That also has risks that they can fail. Another example of that is AppLovin. It has somewhat the same characteristics. I recently bought more, which has increased my average purchase price. So, that plus 70% was initially higher. I'll show it to you. I think I definitely bought AppLovin in 2023. So the first time I bought AppLovin was on January 5th, and the second time on March 4th. And I'm also curious about what the return was on that 5 January. So that's here. On January 4th, I'll take a look at it. That's 130%. So also AppLovin has increased by 100%. It seems to have a somewhat higher valuation in the short term, but this company really has interesting good opportunities. It also has some disadvantages, high debts due to acquisitions. But this is also another example of AppLovin. These are relatively smaller companies that could potentially become major players over time. However, it comes with a lot of ups and downs, as the valuation is difficult to determine. So this was actually a part about investing and stocks. A brief update. Hopefully you found some useful information in it. And now, as the final part, the ETFs, an update on the ETFs. But in the last section about starting to invest and the relationship to exchange-traded funds, there is also an update on my own ETF portfolio. I already said if you want to achieve a return of 7% per year, and that is enough for your financial goal, just stick to investing in ETFs. And if you ask me, you can just do that with 2 ETFs or with 1, depending on how you feel about it. The first ETF is simply the large cap ETF. Large cap refers to large companies, and it essentially tracks a whole set of more than 1,000 large companies worldwide. Among them, there are 2, one of which is well known, the VWRL. That is the Vanguard All World ETF. And you have another one, which is actually the one I prefer. That is the iShares World ETF from IWDA. There are somewhat fewer companies in there, I think around 1,500 or so. A bit more concentration. 1,500 companies. You are simply going to ride the wave of the global economy. It's really that simple. And then the second, because those are large cap companies, you can complement this ETF with small cap companies. That is the one I still have, which is the ICS World Small Cap ETF. It contains 3,000 small cap companies, but on a global scale. For example, you also have the Russell 2000. These are small cap companies in the United States only, but this ETF, this fund, the ICS World Small Cap ETF, focuses on 3,000 companies worldwide. Then you have 2 different ETFs that complement each other, so you have no overlap, but a lot of risk diversification in both large and small companies worldwide. And more than that, you really don't need. Just invest a certain amount every month and stick with it for a long time. And if there is a market crash, try to invest some extra cash. Try to buy a lot more when the market drops. It may feel contradictory. The beginning is very difficult, and you might be in the red for a long time. So be it. You have to look at it for the long term. Warren Buffett always says, yes, if you are going to eat hamburgers for your whole life, you would want the price of them to go down, at least in the short term. Because in the long term, you want the price to rise, of course. So that is the essence of investing. Buy when markets are down, but do not try to time the markets if you do not understand them. Market timing often turns out poorly. But what is possible and what I do, and it remains to be seen whether it works out well, is that I am not timing the market. So my money is invested, as you can see. Of that 180k, 170k is invested. So I'm not timing the market. My money is still in the market. The only thing I'm timing is different categories within the market. Recently, I have sold a number of stocks or ETFs. I will show it to you. First of all, I sold the VVSM. Oh, I certainly didn't take that. That is the semiconductor ETF. You see, the last time I bought more was in July 2023. And since then, I have actually sold more and more. Sold. And actually one that I have had in my portfolio for a long time, or an ETF that I have had for a long time, is the Invesco QQQ. This is actually one of the best ETFs out there for technology stocks. However, I am convinced that I haven't even bought more since 2023. I have only sold I am convinced that technology and semiconductor stocks are simply overvalued, and this will continue for a while due to major players like Google and Nvidia performing very well. There is a lot of risk involved there. When you talk about great companies, they are great companies, but I think Nvidia is very overpriced, and people do not take unforeseen events into account. They would not take into account a black swan event, even if something happens with a company that is worth $2 trillion, which is as much as almost the entire energy sector. Yes, I won't go into it too much, but I would say to watch out for the risks. My money is currently invested quite a lot in the energy theme. Serious amounts in energy. The uranium ETF is somewhat speculative, I would say, because in China, for example, they are building quite a few uranium nuclear power plants. So the macroeconomic setting seems favorable for uranium, but it is once again a cyclical investment. Therefore, I primarily use technical analysis for this. And I have already shown that in another video, so we won't discuss it here. The same goes for the VanEck rare earth and strategic metals, especially for niobium. I recently bought more of that. It's not performing very well, but I will show it to you. Recently, I have increased some positions there. There has been quite a drop. In the long term, you can see that it may continue to decline. It is currently at 50. It could easily drop another 30%. Only purely from a technical point of view, there is also upward potential. In any case, almost 100%. And if those factors do not become interesting again for the long term, because I think they could be, then the upward potential is relatively higher. Uranium, VanEck rare earth, as well as oil and gas and ETFs, are all characterized by less favorable sectors. Where initially the money flowed out of the way, if you see that technology stocks are becoming very expensive and a correction occurs, then the money has to go somewhere else. Oil and gas is an example, a typical good example of the whole story about sustainable energy transition, and I am completely in favor of that. My energy costs are super low, solar panels, this and that. Only when talking about investing do people fail to take into account the global population and global demand. If the energy transition to sustainable energy falls short, which seems to be the case with a significant shortage in engineering, and I happen to work in engineering, there will be a large shortage in engineering, longer lead times, and higher costs for energy. If everything turns out poorly, then those transition goals will not be met. The consequence is that there will be a greater demand for oil and gas. And countries from Africa and such, do you really think that, of course, solar energy is relevant for them, but wind energy is relatively very expensive? Then much energy is more economical, energy more efficient. And it is cheaper to use oil, for example. The same goes for Asia and China. So I think that here the scope in the Netherlands is a narrow-minded view. Yes, we are very prosperous, so sustainable energy is relevant, but for many other countries, that is not the case. Yes, long story short, you need to support it yourself with data and sources, but I think this is a good reset for at least the medium term until 2026, 2027. Maybe I am fortunate to have a bit longer. And then we have ICS, Global Clean Energy. No updates on this, no additional purchases, at least not this month. Yes, I think overall that a small bottom formation could also occur here. You can see a small bottom formation here. It is starting to decline again. It could be that it stays in a trading range of, 7 to 8 or something like that. That could be the case. However, the valuation has at least returned to normal now. The fundamental valuation. If you have started investing, you should look at the price to earnings ratio. The lower, the better. However, it is also about the potential for future growth, and for that, you need to understand what types of stocks are in that fund. Well, it seems to me that this is indeed the case for ICERS Global Clean Energy at the moment. It has had a significant correction. So yes, you should sell when other people with less knowledge are buying based on the media. And you should start buying again when there has been a significant drop and the market has lost a lot of confidence. That is essentially how you can achieve potentially higher returns with stocks, but also with ETFs. So you see, an ETF portfolio that is very concentrated in energy. This is not recommended for beginners. For beginners, you only need 2 ETFs or just one, a kind of Vanguard All-World ETF, which is available at Maxim, for example. Then you invest in thousands of companies, large and small, in energy, as well as technology, spread all over the world. Then you need one ETF, low costs, passive investing, invest every month. That is the simplest way to start investing, where you avoid risk and can still achieve a nice return of about 6 or 7% per year in the long term. Well, a lot of information. Not always very structured. Hopefully you still found it useful. An update on the portfolio and in relation to starting to invest. Thank you for watching. Be sure to check out our other videos. It will make more sense. And if you have any questions, let me know. Thank you for watching and see you next time.